In the hidden data centers where billions of dollars change hands every second, an invisible revolution is unfolding. Artificial intelligence is no longer just assisting human portfolio managers, it is becoming the portfolio manager itself, making decisions that affect trillions of dollars and fundamentally transforming how the world manages wealth. The transition is happening faster than most investors realize, and those who understand it will have enormous advantages over those who do not. The wealth management industry is experiencing a tectonic shift that mirrors the rise of electricity or the internet. Within just the past 3 years, the adoption of AI-powered portfolio management has accelerated exponentially. By 2025, more than 70% of asset managers have integrated artificial intelligence into their core investment processes, compared to just 45% in 2021. This explosive growth represents far more than a technological upgrade. It represents a complete reimagining of how investment decisions get made. The numbers tell a startling story. The global market for AI-driven asset management was valued at approximately $107 billion in 2025 and is projected to reach nearly $1.2 trillion by 2035. That represents a compound annual growth rate of more than 26%, indicating that artificial intelligence is not a fringe experiment, but is becoming the central nervous system of the investment world. The firms betting their futures on this technology are not small startups taking wild chances. They are the most prestigious financial institutions on the planet. When machines outthink markets, the most powerful artificial intelligence portfolio manager operating today is BlackRock's Aladdin platform, a system that manages approximately $21.6 trillion in assets. To put that number in perspective, this single platform controls more wealth than the combined gross domestic product of the United States and China. Aladdin was built specifically to manage risk and optimize investment decisions, and it has evolved into something far more profound than anyone anticipated when BlackRock founder Larry Fink first imagined it decades ago. What makes Aladdin extraordinary is not just its scale, but its omniscience. The platform generates millions of risk reports daily, analyzing patterns across global markets that no human analyst could possibly understand. It connects the information, people, and technology needed for investment management into a unified ecosystem. More than 200 institutions across 70 countries depend on Aladdin to make critical investment decisions, including pension funds, sovereign wealth funds, and central banks. When the financial system faces crisis, institutions turn to Aladdin to understand what is happening and how to respond. JP Morgan Chase developed another revolutionary AI portfolio manager called LoxM, an engine designed specifically to execute equity trades at maximum speed and optimal prices. JP Morgan trained LoxM on billions of historical transactions, teaching it to predict how other traders would react to massive orders and to execute them without causing market disruption. When JP Morgan tested LoxM against both manual and automated trading methods, it dramatically outperformed everything the bank's human traders could accomplish. The results were so impressive that JP Morgan rolled it out across Europe, Asia, and the United States. What separates LoxM from traditional trading algorithms is its ability to learn continuously. It does not follow rigid rules, it adapts. Each trade teaches the system something new about market dynamics, trader psychology, and execution strategy. This creates a feedback loop where LoxM becomes progressively smarter with every passing day. Traders at JP Morgan report that adoption of this system improved execution efficiency by approximately 15%, which translates to millions of dollars in cost savings and better outcomes for clients. Morgan Stanley took a different approach, deploying an internal artificial intelligence assistant built on generative AI technology. This system answers over 55,000 questions from the firm's 16,000 financial advisors, drawing from an internal library of 100,000 documents and research reports. The system understands what each advisor needs to know and synthesizes information in seconds, something that would take a human researcher hours. The productivity gains have been extraordinary. Financial advisors using this artificial intelligence tool now save approximately 15 hours per week on administrative tasks, giving them more time to engage with actual clients. The impact on Morgan Stanley's business has been measurable and enormous. The firm generated $63 billion in net new assets in the third quarter of 2024, acquired 100,000 new clients, and directly attributed this record-breaking performance to the efficiency gains provided by artificial intelligence tools. Morgan Stanley's executives have been clear that without these AI systems, achieving that growth rate would have been impossible. Real-time risk management that never sleeps. Before artificial intelligence, portfolio managers conducted risk analysis quarterly or perhaps monthly. If something unexpected happened in global markets, you might not know your portfolio was exposed to that risk until it was far too late. Artificial intelligence has changed this fundamentally. Modern AI systems monitor portfolios continuously 24 hours a day, analyzing thousands of variables simultaneously to identify hidden risks before they become catastrophic problems. BlackRock's Aladdin platform includes sophisticated stress testing capabilities that simulate thousands of potential market scenarios. It can model what would happen to a portfolio if interest rates spiked by 2%, if oil prices crashed, if a geopolitical crisis occurred, or if multiple crises happened simultaneously. Financial institutions using Aladdin have reported identifying potential portfolio threats an average of 9.2 days earlier than institutions using traditional risk management methods. In the fast-moving world of investment management, a 9-day advance warning can mean the difference between profit and loss, between stability and disaster. Institutions now use artificial intelligence for what is called dynamic risk budgeting, where the system automatically adjusts portfolio allocations to maintain optimal risk levels based on changing market conditions. This is radically different from traditional approaches where a portfolio is set and rarely adjusted. AI-driven portfolios are living, breathing entities that adapt to the world around them every moment of every day. The performance revolution. The question every investor asks is simple: does this actually work? Are portfolios managed by artificial intelligence actually better than those managed by humans? The evidence is overwhelmingly clear that the answer is yes. Financial institutions deploying AI-driven portfolio management have reported a 27% improvement in portfolio performance while simultaneously reducing operational costs by 15 to 22%. That is not just one metric improving, it is multiple measures of success accelerating at the same time. Asset managers implementing AI tools have seen assets under management increase by an average of 32% within 18 months of deployment. The productivity gains are similarly impressive. Using AI to eliminate 50% of manual investor prospecting and onboarding tasks has increased investment managers' productivity by more than 14%. When compliance and risk operations are automated, operational costs drop by 25 to 50%, freeing capital that can be reinvested into client service or profit margins. JP Morgan's adoption of various AI systems generated $1.5 billion in cost savings between 2023 and 2024 alone. This is not theoretical savings. This is actual money that went to the bank's bottom line. Every major financial institution has similar stories to tell. Cost reductions compound when they become systematic across entire organizations. Looking forward into an automated future, the future of AI-powered portfolio management is moving toward what the industry calls agentic AI, where the system does not just analyze and suggest, but actually executes decisions autonomously within predefined parameters. Goldman Sachs, JP Morgan, Morgan Stanley, and BlackRock are all pursuing this vision. Imagine a portfolio manager that never sleeps, that monitors global markets across all asset classes, that identifies opportunities in real time, and that executes trades to capture those opportunities within milliseconds, all while operating within constraints that reflect your risk tolerance and investment philosophy. The practical impact on wealth management is profound. Fees are declining as automation reduces cost. Performance is improving as artificial intelligence processes information faster and more comprehensively than humans ever could. Access to sophisticated strategies is democratizing as tools that once were available only to the ultra-wealthy become available to ordinary investors. The future of wealth management belongs to institutions that embrace this transformation fully rather than resisting it. The age of human-only portfolio management is ending. The age where artificial intelligence augments and amplifies the best human decision-making is here. Those who understand this transition and adapt to it will thrive. Those who do not will find themselves competing against systems that simply operate on a different plane of capability.